So what is an income statement? An income statement is a financial statement that reflects a company's revenues and expenses for a period. For example, this income statement that you see is an income statement of a company that sells toys. We mentioned that an income statement reflects the results of operations, that is revenues and expenses for a period. What period does this income statement cover? You can see at the top that this is an income statement for the year ended December 31st, 2018, which means this is an income statement for 12 months. You can have an income statement for a year, just like this income statement, or you can have income statements for 3 months, 6 months, or even 1 month. This is different from a balance sheet because balance sheet reflects the assets and liabilities of a company at a given point in time. Let's take a personal example. If I ask you to create an income statement for 12 months of your own personal expenses and income, you would look at all the income you received and all the expenses you made for the last 12 months, and that would go into your income statement. But what if I ask you what is the balance on a specific date? Let's say the 31st of last month. That balance would go into your personal balance sheet and not income statement, because that is showing status of balance in your account as of the 31st of last month and is not reflecting a period. This is the key difference between income statement and balance sheet. The next point to discuss is currency and rounding. As you can see in this income statement is stated in US dollars in millions. So as I mentioned, this is a toy company and this is an income statement of a real toy company, although I did make some modifications, but they reflect their income statement in millions of US dollars. So this means that the net sales you see here on this income statement of 13,794 actually really reflect 13.794 billion. The first item on an income statement is net sales. What is net sales? Is gross sales less returns, discounts, allowances, and rebates. The company sells products. The price that the customers pay or have to pay is gross sales. This is then reduced by items like returns, discounts, allowances, and rebates. So what are sales returns? You sold a product to a customer and they didn't like it, so they return it back to you. This is sales returns. And what is discounts? If you provide your customer with early settlement discount, so for example, your customer has a normal credit term of 30 days. They can pay you within 30 days of receiving the invoice or receiving the product, but you give them an incentive. If you pay the money within 10 days, you get an additional 2% discount. And then allowances and rebates. Sometimes when you ship a product to a customer, there are rejections, they don't like something about the product. Rather than asking them to return the product, you give them an allowance. You reduce the amount that is payable by your customers. So net sales is really gross sales less returns, discounts, allowances, and rebates. The next item on the income statement is cost of sales. Cost of sales is really the cost of product or service sold to customers. Note that it does not include the cost to sell the product or services. It is really only the cost to produce the product or service. Another term used most commonly by manufacturers is cost of goods sold, which is basically the same. Cost of sales can be calculated by using a formula which is beginning inventory cost plus cost of goods manufactured minus ending inventory cost. This formula is used by manufacturers. So if this toy company manufactures the toys, they would use this formula. Nowadays, the system can do the calculation for you, but this is good to know how cost of sales is calculated. A retailer, on the other hand, would use a slightly different formula, which is beginning inventory cost plus cost of purchased inventory minus ending inventory cost. You can see that the formula is pretty much the same, except where manufacturers use cost of manufactured goods, the retailers use cost of purchased inventory, which makes sense because retailers do not manufacture the goods. But effectively, what you need to know is cost of sales really represents the cost of producing the product or service that you sell and exclude all other costs. Next item is gross margin, also known as gross profit. And this is really the difference of the net sales value and the cost of sales. As you can see here, $4.8 billion of gross margin is the difference of $13.8 billion in net sales and 8.9 or roughly 9 billion in cost of sales. Up to this point, what we can see is that the company made sales of 13.8 billion. They have so far saved $4.8 billion. But this is not all. There are other costs for running the business, which are known as the operating expenses. The first of those operating expenses is selling, general, and administrative expenses. What are selling expenses? Selling expenses are the expenses of the sales department. It may also include marketing expenses if the company lumps the two together. So this would include the salaries and benefits of the sales staff and sales managers. This would also include advertising and marketing expenses, really all the expenses related to the sales department. General and administrative expenses are all the other expenses. This would include the back office functions like human resources, finance, IT, etc. Next item on the income statement is depreciation and amortization. What is depreciation? Depreciation is an allocation of cost of fixed assets over their useful life. For example, the company buys a computer. A computer is a fixed asset because it is expected to be used by the company for more than 1 year. Now the cost of computer in this case is $900 and the useful life is estimated to be 3 years. The depreciation expense per year for this computer would be $300. So in the first year the computer is bought, the income statement would show a depreciation expense of $300. And then the next year another $300 and the year after another $300. Ultimately, the total cost of the computer is allocated over its useful life, 3 years. What would happen to the remaining $600 at the end of year 1? When we have charged $300 to the income statement, there are $600 of cost. Well, they remain in the balance sheet until we depreciate them in the years moving forward. Amortization is very similar to depreciation, except that with amortization, it is the intangible assets which are considered rather than the tangible or fixed assets. Example of intangible assets which can be amortized are licenses, trademarks, copyrights, and patents. Next item on the income statement is net gains or losses from the sale of properties. This reflects sale of fixed assets. So for example, if this computer, after using it for 2 years, the company sells it, we know after 2 years we have already charged $600 to the income statement and the remaining balance of the asset in our balance sheet is $300. Now let's say we sold this computer for $250. Well, in that case, we will have a loss because the book value of the computer is $300 and we sold it for $250. So the difference, $50, is a loss on sale of properties. This leads us to the total operating expenses, which is really the sum of selling, general and admin, depreciation and amortization expenses, and net gains or losses on the sale of properties. At this point, we are able to calculate the total operating earnings. In this case, we have total operating earnings of $696 million US, which is the difference of gross margin and total operating expenses. Next item on an income statement is interest expense and interest income. Interest expense is really interest paid on loans acquired by the company, and interest income is the interest on any bank balances that a company has. This leads to our earnings before income taxes. As you can see, it is the sum of operating earnings less interest expenses plus interest income. The company's total earnings before income taxes is $220 million, which leads to our income tax expense or benefit, which is $67 million. And then finally net earnings, which is $153 million US for this company. So we started with net sales of $13.8 billion, and finally the company is left after considering all the expenses and revenues with $153 million US. Well, this is income statement for you. So far we have learned what an income statement is. In the next video we will learn how to analyze an income statement and understand the financial performance of a business. Make sure to like this video and subscribe to the channel. See you in the next video. Bye for now.